Living on dividends, a pathway to financial freedom. Imagine waking up each morning not to the sound of an alarm clock, but to the sweet chime of dividends landing in your account. Financial freedom, often seen as a distant dream, is more attainable than many realize. It's not about amassing a fortune overnight. It's about crafting a strategy where your money works for you, generating a steady income stream without depleting your principal. Today, we're diving deep into the concept of living off investment dividends, targeting an income of $2,900 per month or $35,000 annually. This isn't just a pipe dream. It's a practical goal achievable through strategic investments. Let's explore the historical context, global impacts, sector-specific opportunities, and 3 actionable strategies to make this a reality. The historical context of dividend investing. Dividend investing has long been a cornerstone of wealth-building strategies. Dating back to the early days of stock markets in the 17th century, companies have rewarded shareholders with a share of profits, known as dividends. In the U.S., the concept gained prominence during the industrial era when blue-chip companies like railroads and utilities began paying consistent dividends to attract investors. Over the 20th century, dividends became a symbol of stability, particularly during economic downturns like the Great Depression and the 2008 financial crisis, when income-focused investors leaned on dividend stocks for reliable returns. Historically, dividend yields have varied with market conditions. In the 1980s, average yields on the S&P 500 hovered around 5 to 6%, reflecting higher interest rates and a preference for income over growth. Today, with yields closer to 1.5 to 2% for the broader market, investors must seek out specific sectors or instruments to achieve higher income. This shift underscores the importance of targeted strategies in a low-yield environment, particularly for those aiming to live off dividends. Global impacts and sector-specific effects. The pursuit of dividend income isn't just a personal finance trend, it has broader implications across global markets. High dividend strategies often drive capital into mature, stable sectors like utilities, consumer staples, and real estate, influencing stock valuations and sector performance. Globally, countries with aging populations, such as Japan and much of Europe, see increased demand for income-generating investments as retirees seek to supplement pensions. This demographic trend fuels interest in dividend-focused products, from individual stocks to exchange-traded funds, ETFs. Sector-specific effects are notable as well. Real estate investment trusts, REITs, for instance, are mandated to distribute at least 90% of their taxable income as dividends, making them a cornerstone for income investors. However, their performance is tied to economic cycles, interest rates, and property market dynamics, factors that can vary widely across regions. Similarly, covered call ETFs, which blend dividend income with options premiums, have gained traction in volatile markets, offering higher yields but with added complexity and risk. Understanding these dynamics is crucial for crafting a resilient dividend portfolio. Strategy 1. Covered call ETFs, a high-yield shortcut. One of the fastest routes to generating significant dividend income is through covered call ETFs. These funds invest in a portfolio of stocks while simultaneously selling call options on those holdings to generate additional income via premiums. This dual income approach, dividends from stocks plus options premiums, often results in yields in the double digits, far surpassing traditional dividend stocks. Popular covered call ETFs boast trailing 12-month yields around 11.8%, making them an attractive option for income seekers. To achieve $35,000 annually with an 11.8% yield, an investor would need to allocate approximately $280,000 to $310,000. A far cry from the $2 million required, with traditional dividend stocks yielding 1.5 to 2%. However, these ETFs carry risks, including potential losses if stock prices decline significantly or if options expire worthless. They are best suited for investors comfortable with moderate volatility and a nuanced understanding of option strategies. For those starting out, covered call ETFs offer a relatively accessible entry point to high-yield investing without needing vast capital. Strategy 2. High-yield REITs, real estate for regular income. Real estate investment trusts, REITs, present another compelling avenue for dividend income. REITs invest in income-producing properties, think malls, offices, and apartments, and distribute a significant portion of their earnings as dividends. Some REITs offer yields as high as 19 to 20%, with historical average annual returns around 10.8% over the past 2 decades. To generate $35,000 per year at a 10.8% yield, an investment of about $320,000 is required, though this can vary based on specific REIT selections. REITs are particularly appealing for their monthly dividend payouts, providing a steady cash flow ideal for covering living expenses. However, their performance is sensitive to economic conditions, interest rate hikes, and occupancy rates, making diversification across different property types and geographies essential. For investors, REITs combine the benefits of real estate exposure with the liquidity of publicly traded stocks, offering a balanced approach to income generation over a 5 to 7 year horizon with disciplined saving and reinvestment. Strategy 3. Dividend Aristocrats. Stability over flashy yields. For those prioritizing consistency over high yields, Dividend Aristocrats, S&P 500 companies that have increased dividends for at least 25 consecutive years, offer a bedrock of reliability. These companies, often in stable industries like consumer goods and healthcare, average yields around 7%. To reach $35,000 annually at this yield, an investment of $500,000 is needed, more than the previous strategies, but still a fraction of the capital required for lower-yielding traditional stocks. Dividend Aristocrats are less susceptible to economic downturns, making them a safer bet during market turbulence. Their track record of dividend growth also provides a hedge against inflation, ensuring that income keeps pace with rising costs. Investors should diversify across multiple aristocrats to mitigate company-specific risks, creating a portfolio that balances income with long-term capital appreciation. Investment and policy implications. The pursuit of living on dividends has significant implications for both individual investors and broader financial policy. For investors, these strategies highlight the importance of aligning investment choices with lifestyle goals and risk tolerance. Covered call ETFs and REITs offer higher yields but require vigilance over market conditions, while dividend aristocrats prioritize stability at the cost of larger upfront capital. A blended approach, combining elements of all three, may provide the best balance of income, growth, and risk management. From a policy perspective, the growing interest in dividend income underscores the need for regulatory frameworks that support income-focused investments. Tax policies on dividends, for instance, vary widely across countries, impacting net returns for investors. In the U.S., qualified dividends are taxed at favorable rates, but potential changes to capital gains taxes could alter the attractiveness of these strategies. Policymakers should also consider incentives for companies to maintain or increase dividend payouts, particularly in sectors critical to economic stability. Near-term catalysts to watch. Several catalysts could influence the viability of dividend-focused strategies in the near term. First, interest rate movements will play a pivotal role. Rising rates, as anticipated in response to inflationary pressures, could dampen REIT performance by increasing borrowing costs, while making dividend aristocrats more attractive relative to bonds. Second, economic recovery post-pandemic will impact corporate earnings and, by extension, dividend sustainability. Investors should monitor earnings reports for signs of dividend cuts or increases. Lastly, geopolitical tensions and energy price volatility could affect sectors like utilities and real estate, necessitating a nimble approach to portfolio adjustments. Conclusion: building your dividend dream. Living on dividends isn't just a financial strategy, it's a mindset shift towards sustainable wealth. Whether through the high yields of covered call ETFs, the steady cash flow of REITs, or the reliability of dividend aristocrats, achieving $2.900 per month in passive income is within reach with the right plan and patience. Start by assessing your financial needs and risk appetite, then allocate capital strategically across these vehicles. Diversify to mitigate risks, reinvest dividends to compound growth, and stay informed about market and policy shifts. Financial freedom isn't a far-off fantasy, it's a tangible goal, one dividend payment at a time. So take that first step today. Visualize your future, crunch the numbers, and let your investments pave the way to a life of independence.